All right, well, we haven't had a day like that in a while. So a big down day, especially in the NASDAQ 100. I guess we did have one last week, kind of like this, but more significant of a decline today, building on what we saw last week. And so that brings up the question now is this intermediate run done, right? Have we dropped enough that it's more than just a near-term decline? We continue the run to the upside, fine. Or are we done? We're kind of at a pivot point. I'm going to tell you the signal that suggests the pivot point that we're at. We're kind of at a pivot point right now where we can start a more extended intermediate pullback, whether it ends up being a pullback or correction. That was actually the topic of my technical analysis class today for our premium Market Scholar subscribers. There's signs for us to watch for that. But are we going to start a new intermediate decline to the downside, or are we going to start another leg higher of this current intermediate run and really get going again? And push up. So that's kind of the signal. I'm going to show you why we feel that way, what's kind of cropping up, and which way I'm leaning, right? Which way I think will actually go based off of the kind of decline that we've gotten here today. Especially, like I said, in that NASDAQ 100 and what we're seeing in some of the other Mag 7 stocks that are already maybe leaning in the direction of where we might go. So we'll take a look at that, take a look at what's driving this action. Interestingly enough, it was not what you'd expect from a market intermarket relationship standpoint. There was a surprising move in another asset class that still put pressure on the Qs. So we'll take a look at that and what that means. We'll take a look at the sector rotation, which is sharp, and what that means. A very significant change. Looks like a certain ratio has broken. We'll talk about that. And then finally, our trade idea is a way to try to take advantage of that pivot point on a very popular stock that a lot of you have heard of and traded yourselves. So let's go ahead and get started. Today is Wednesday, July 17th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video where I take a look at the old trades we've done. We actually rolled a trade from an old Market Outlook video today. We closed out another one. We put on today's already before the market closed during this class, so check that out there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button. Same thing here. Open up this thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who like us day in and day out. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we ended up down 1.4% today. So we talked about a couple of days ago this idea of the near-term line coming out of bearish territory, but with the momentum line finishing lower than the near-term line, a good chance that the second day doesn't get to the 80th percentile or higher, and that's what ended up happening. And then, of course, the drop out of bullish territory now, with the drop to extreme lows on the momentum line, suggests a very good chance that we get a near-term low point tomorrow. Now that would mean another day of declines tomorrow. So we'll see if that ends up happening. It's very rare for us to have like multiple days of strong declines here. You notice since we've been on this bullish run on the S&P 500, we might have one down day, but we haven't had a couple of down days since the pullback. Right, and when we're not in the pullback, we only might get one down day of 1% or more, but we don't stack them up until we are in an actual decline. So it's a one down day. Now, granted, this was a pretty significant gap to the downside, more than a 2 standard deviation gap to the downside. So one of your bigger gaps that we've seen, again, would suggest some forthcoming weakness for the S&P 500. So, which means, especially with the momentum line down as far into the reversal zone, would suggest that there's a good chance the near-term line gets down into the reversal zone. And again, if it does that tomorrow, then we follow up a bearish near-term peak with a bearish near-term low point, and now We know we have concerns about the intermediate line being above market sentiment because there's a good chance it crosses below, even though it's at the 90th percentile still, and it will still be above the 80th percentile, but it would be crossing below market sentiment. And if it does that anywhere, that's a sign, potential, right? A potential sign of weakness. Here it did it, but we didn't get any bearish signs, right? Over here, we got a, we crossed below, we had a bearish peak, bearish low point, and there we go, right? So we'll see how that ends up happening. The NASDAQ 100, of course, has got, the near-term line formed even a more bearish peak than the S&P because we only spent 1 day out and we were right back down there. The momentum line down to extreme lows. The intermediate line has crossed below market sentiment easily and is now close to crossing out of the reversal zone, which means light pink shading. So tomorrow we might end up with a bull tag. We got a bull tag in a lot of the NASDAQ 100 stocks. If you look at, a bull tag, remember, is light pink shading and a yellow line. We close below the moving average, which gives us a yellow line, and then light pink shading. So that combination on the same day gives us a bull tag. So you can see we actually, whoops, not this chart. We actually got that on a lot of these stocks. NVIDIA, which we'll come back to later in the video. NVIDIA's got one. Google got one today. Amazon got one today. Broadcom got one today. Microsoft got one today. Meta had one a couple of days ago. Qualcomm had one a couple of weeks ago. Netflix had one a couple of days ago. So, we had all, these are all the patterns. Those are all bull tag patterns, which are pivot points. They are like significant pivot points because either we bounce back up and keep going up for a while, right? A really, really good run to the upside. So something like this, right? This was something like it, but we didn't close below the moving average, but we did get the light pink shading. So, and you can see how we ran up for a good period of time after. So we either start another good run where we stay bullish in the intermediate posture and we just get a good leg higher, or we start our decline, right? The intermediate decline. This one didn't last very long, but you can see this one lasted a lot longer. So it's a pivot point of the beginning of a big move one way or the other. A big move one way or the other. And so that's kind of what we're seeing right now on the NASDAQ 100. Now the nice thing about this is like the Russell 2000 still very strongly bullish. It's run up so much. It's still very much above the moving average. Still at 8.75%. The near-term line is still very strongly bullish. The momentum line is not very bearish itself. So, that's still a good sign. And yes, near-term line is crossed below, but that doesn't matter when you're in the reversal zone, right? It's the market sentiment line, the intermediate line, that you look at in the reversal zone. Any other crossover has to occur in between the reversal zones for it to really matter. So the Russell's still very strongly bullish. And the Dow Jones actually went up today at 0.5%. So the near-term line got up to an extreme high point, the 97th percentile, 97.5. It's in the 91st percentile above the moving average. It's almost 5%, which is like we talked about the Russell being 10% yesterday, and that's like that rubber band stretching. Well, this is 5% for the Dow and the S&P. You get to 5% above, now your rubber band is stretched. It doesn't mean we have to drop back down. It just limits the upside until the rubber band starts to come back. Remember, the rubber band can come back down with the moving average just moving up faster, right, and bringing us back down to like this, to an easier level that we can stay at and still stay bullish. Right, that's kind of the idea behind the Dow Jones Industrial Average. Let's take a look at the weekly chart. And despite the weakness today, we still have a higher Hakunashi close, and we still have a higher high. So we're actually still okay. That's not a bad thing. Your NASDAQ, remember that one's looking a little weaker. That's a little different story. This is a transition candle, right? A small body, upper and lower shadow. And again, it's a relatively bearish candle. If it got more bearish, then we'd really be in trouble on the next day, a couple of days. It's not too bad yet, but still, regardless, it's a transition candle. You're still very, very high on the PPO, and we haven't gone negative yet, but you can kind of see, that transition candles lead to the signs of weakness, to the intermediate trends to the downside, especially when the gap between the 50 or the 10 and the 40-week moving averages is as high as it is. If you take a look at the 3 green arrow chart, you can see that we did actually have 3 red arrows briefly today on the Russell 2000, on the Qs. We ended up finishing above it, so we didn't get the pink shading in the yellow line today. So we're close to 3 red. We're the closest to 3 red arrows on the Qs. Everything else is like the Dow and the Russell aren't even close at all. The S&P has one red arrow, so we're now finally done with the 3 green arrows on the S&P. But we're still all okay, right? This is still not like, even if we get, assuming we get, if we drop tomorrow, 3 red arrows on the Qs, it still wouldn't have it would be a yellow line instead of a red line. 3 red arrows with the red line is when we really start to worry about things. If you look at the 2-line version, you can see the S&P broke the 8-day moving average. That is not that big of a deal. We break the 8-day a lot, right? So it's not that big of a deal. The MACD did break. Remember, so we had the red arrow, which means now we're in convergence mode, where the MACD is below its moving average. We have the red arrow, but we're still above the 17-day, a little bit above average volume down there at the bottom. If you look at the Qs, we just broke the 17 pretty easily. The MACD is clearly below the stochastics, is now out of bullish territory. Strong volume down at the bottom. So that's why I think there's a good chance we make a run at least to the 50-day moving average, where you will have some support, right? There will be some support right here at the 50. There's some Fibonacci support on multiple time frames right in this area. So that will be kind of the idea, where if we get a pullback of, say, 5% here on the Qs, so here's the NASDAQ 100. If we end up, I mean, we're already at 4.25, so to get it, if we end up with a 5, 6, 7% drop, that's probably ultimately all that it would get down to, is right down to those Fibonacci retracement zones right here in this area. For the S&P 500, for SPY at least, that would be the equivalent of dropping down towards 530 in this area, a little bit below the 50, but down to its 50% retracement on the intermediate run, and the 23% retracement of its market sentiment rally that we've been on, the last 2 intermediate rallies that we've been on. All right, let's take a look at some of these other oscillators. The S&P 500, you're still pretty bullish. Like, you're still well above 25 in the positive, and now you're back above 10. Remember how extremely low we were. You're back above 10 now, but you're still well below 20. That's not the case for the Qs. You got a bearish crossover on the Qs. Well, at least you did for most of the day. It looks like by the end of the day, it finished right about equal levels. The negative indicator closed at 26.15. The positive closed at 26.00. So barely a crossover, barely, and they're both above 25. So again, the positive would have to get below 20 if we're really going to trend to the downside and have an intermediate decline down to the downside. If you take a look at a little dip below 25. It actually would not be a bad thing. As you can see, the last time we had a little dip below 25, it started a new leg higher on the positive. And a little dip above 25 on the negative, again, is not a bad thing, as it started a new leg higher. And we very well could be doing that again here. Looking at the RSI and the CCI, again, we're out of bullish levels, but still above 60. We're still above 0 on the S&P. So these are still all green boxes. We can't change these yet. So we're still green there. And we're still green here on the CCI. Remember, we don't take it off of being green until the CCI drops below minus 100, which obviously we're nowhere near that happening. And we don't take the green off and turn it red until we drop below 40, right? And obviously we're not anywhere near that happening either. All right. So we're still easily bullish. If you look at the NASDAQ 100, we are below 50, right? So we are in the lower half of the chart on the RSI, but not below 40 yet. And we are down below 0. Now, we're not below minus 100. We need a kind of a second day. We talked about that candlestick pattern of, 1 down day, 3 kind of bullish days in the middle of that range, and then another big range. In this case, we don't see a big range because we gap down so much. But still, it's the same idea. That's kind of what we're seeing there on the NASDAQ 100. So it looks like we could. I mean, again, we dropped down here on this pullback, and now granted we didn't drop below 50, but we dropped down to this level and bounced back up. We've seen other dips below 50 even, and below 100 even on the CCI, and we bounced back up. So there's still a good chance, considering the buy the dip mentality that's out there in the markets. There's still a pretty good chance that we bounce right back up off of this move. We'll take a look at the stochastics here in just a second. Let's look. I want to take a look at the whole. We didn't look at the whole moving average. So the S&P finally broke the 20-day whole, but it's still green. The whole is still green. You can see we broke below the moving average here on the one. You can see how big of a candle this was, a pretty significant size candle to the downside. But look at the Qs. The Qs, we have turned red, so we flipped the parabolic SAR up. We have turned red. It was a very big candle, relatively speaking, about as big as at the bottom of this move. So this is different because we're starting a move to the downside. We are breaking well below that average. Like I said, turning red, flipping the parabolic SAR. So a pretty significant pattern there. Now let's go to the Ichimoku cloud. We're barely breaking the 8. You still have a trend. You don't have a trend anymore on the Qs. No, you still do have the trend. You won't have it on NVIDIA here in a second. We haven't broken that blue line yet. You're still very positive, well above the cloud. Still, we haven't turned pink yet on the cloud over here, which is 26 days forward. So we're still fine, right? We still have a very mature, very strong bullish trend. IWM, remember, now has gotten mature with this extreme move up to the upside, and then Diamonds has also gotten mature here with its big strong move up to the upside. Looking at the Bollinger Bands, the S&P is no longer above the Keltner channel. That's how big of a move it was. Remember, your momentum has been very strong for a long time as we've been above the Keltner channel. Your bandwidth is still rising. We're still in the upper half of the bandwidth. Not the case for the Qs. The Qs, we are in the lower half, not the lowest quartile, but we're in the lower half for the first time, and momentum is declining pretty rapidly as we are now way, we're easily not out above the Keltner channel. Again, not the case for IWM. IWM is still insanely above its Keltner channel, right? So way, way, way up above it. Has very, very strong momentum, right? About as strong as we saw over here. Very strong momentum, and now we are finally like barely below the upper Bollinger Band. And the bandwidth is extreme. I mean, this is a big extreme move to the upside. And there's, again, it's lagging, so it's still going to go up. It might very well could cross up above this 16.5. That's how, and again, that's rare for that to happen on a bullish move. In this case, it also moved up to a big, and we ended up peaking at that level, and we'll see if that ends up following suit this go around. If you look at the 4-week range, you'll see that, again, kind of a runaway gap to the bottom, which, again, is a sign that we might be a little bit more bearish than we think because of this runaway gap potential where we gap down by a significant amount. I showed you earlier, a significant amount, and we just kept going down. You see it's very prominent on the Qs, right? Big gap down, and then we fell down and closed at the lows of the day. Ended up closing nearly 3% down on the day today. So very much a runaway gap potential, especially you notice we got down below the lower half of the chart, which is what I wanted to show you here. I mean, that's we're still in bullish territory on the bullish chart and the extreme highs on the Russell, but on the NASDAQ, that's a big drop, down into bearish territory. Like, we've had drops like this before, but when it's dropped down to this level or more into bearish territory, it usually stays there for a while, as you can see over the last little bit. If I were to zoom out so you can see some more context. Again, you can see, like, we've had one little dip right there in 2023 where we dipped down below 20 and then we bounced back up pretty quickly. But for the most part, and another one right over here, but for the most part, when you get to this level, it stays down there for a while. We are in that's a good sign that we are in intermediate decline. So breaking into the lower half of the chart, and then, like I said, staying down there, right? Staying down and finishing at the lows. I mean, very, very much a runaway gap potential. And if you take a look at today's volume and trading range on the S&P, it was not that significant. It wasn't too above average, right? It was a little bit above average, 56 million. And then the range, when you look at the range here, so from the close 564 to the high of 560, so we are down about another 4 points, so about an 8-point range. So that's a little bit bigger than the average of what we typically see. Well off the charts here, right? 8-point range. And you saw the volume pick up. You can see the range is moving higher, and the volume you would expect would move higher if we were to stay down. Those are signs. Remember, those lines move up. That's not bullish, right? And you can see the Qs have really moved up here with a big time range. Over the past week, it's really moved up. And you can see the volume is creeping up. IWM has done the same thing, right? Same thing. And now today's was a little bit, it wasn't so extreme, but still they're both rising. And again, would suggest, just as big of a moves to the downside if we were to reverse reverse here and keep these moving up higher again. So we want these lines to start falling. So we want IWM to start really grinding to the upside and maintain that bullishness there. Finally, a big move higher on the VIX today. Closed off the highs, so it didn't quite close above that 10% mark. But still, you notice it closed just right at that 200-day moving average, just a little bit above it. So last time we kind of closed a little bit above it, we came back down. You can kind of see that here too. So we'll see. If we get some follow through and get through it, then again, that's a sign we're in intermediate decline. But we're not quite at that point where we are breaking through to the upside. If you take a look here, let's see. Yeah, so that's the VIX. So I mean, it's a good move to the upside. It's not extreme. You notice we're not above the 95% mark even. We're just barely above 90% relative to VIX 3M. The VVIX jumped up to 88, but that's really not extreme yet either. Right? It's when it gets closer to 100 is where you start to really consider that it's moving up higher. It also barely got above its 200-day moving average for the VVIX. Right, so there's your 200-day. So it's just not extremely low anymore. 80. Remember, 80 is extremely low. So it's not extremely low anymore. It's above its 200-day. Getting closer to 100 now is when you start to worry about intermediate decline or worse. Because remember, a correction. When you have a correction, it gets well above 100. Right. So that's when we were in correction mode. We were well above 100, above the 200-day. Even the 200-day got above 100 over there. So. It's been very low. The VVIX has been very low. The volatility has been very compressed. You can see here that its ATR was already really low to begin with. It is very, very compressed. Remember, 10% is extreme, right? That's extreme right here. So we are very, very compressed on the volatility index. Getting below 20 is extreme, and we are well below that on the weekly chart, even with this little jump we're getting right now. So that's what typically precedes the big moves in volatilities when the compression is so low, when we get such small ranges and the compression gets really low. And you're seeing that, like I said, especially here. These are much lower levels than what you saw even in 2017 when we were notoriously complacent in the markets right here. You can see with the lowest we got to on a range basis was about 7.5% relative to the price. The value of the VIX, and now we are at 6%, so even way, way lower, very compressed, again suggesting the potential for us to get a lot more bullish on volatility, not just getting above the 200-day moving average, but you'd start to look to get above, start to fill in that gap, or even worse, get above the 200-week moving average. But at least filling in that gap there would be kind of a pullback scenario. All right, now let's take a look at what's driving today's price action, right? Big, big moves, and especially, like I said, in the Qs. Let's take a look at just today alone. So July 17th, and we'll go to the 5-minute chart. See that big drop in the Qs over here. In IW, I mean, everything dropped, but the Qs really did. Down 3%, like I said, closing at its lows. Emerging markets, which have been doing pretty well, down 1.5%, just barely underperforming the S&P. IWM outperforming, but not very much, but really outperforming the Qs. And then you can see real estate doing well, bonds still holding up pretty well, again, especially on a relative basis. Gold outperforming on a relative basis. The dollar was down, so interesting to see that despite with this big move to the downside, you'd think, oh, the dollar must have been pretty strong. No, the dollar broke down even more. We talked about there are times where the dollar and stocks can both go down together, and that's usually not typical. It's not very common, but there are times where there is a positive correlation between stocks and currencies. Also stocks and bonds, but stocks and currencies. And the two times where they've both been positively correlated and they both fell were both bear markets. The last two bear markets that we've had. So something to keep an eye on as of right now. There's not, it's not a huge concern yet. You can see the correlation. The correlation between the dollar and the S&P is still pretty negative, so it hasn't turned positive over 2 weeks. Not yet. So we're still okay. It's not a huge concern, but it is a lot less negative than it was. So something to keep an eye on there. TLT, remember, has also been positively correlated with stocks. And again, if that breaks to where it's a negative correlation, that's a deflationary ratio. If they are negatively correlated, right? When they're positively correlated, that's more of an inflationary scenario. So which is what we have been here lately. And I've also mentioned too that the VIX has been positively correlated with the S&P. That dropped today big time, and we are heading into a very seasonally bullish time of year for the VIX. You also saw that, again, that the Russell really outperformed the S&P 500 or the Qs today, right? And so as a result, the ratio chart here of the Qs relative to IWM continued its free fall. And now has closed below the 200-day moving average for the first time since all the way over here in March of 2023 when we had the banking crisis, right, where the Qs really killed IWM because IWM was hampered by the banking crisis, the regional banking crisis. And then, you know, when they both rallied, the positive correlation of the S&P, they both went up, the stocks went up, and we were fine again. But we haven't been below that. Like when you break that 200-day moving average, it's typically a sign of correction mode rather than pullback. Now it's only one day and we're only a little bit below it, so it doesn't look like necessarily I mean, this is very strong momentum. It's the strongest decline that we've seen since at the washout phase of the correction of the last. So very, very strong momentum, similar about almost as strong as what we had over here. The long-term moving average is just turning over below its moving average. Very strong CCI, very high negative directional index, and the RSI is already below 30. So there's a good chance we bounce here because we are extremely low on a lot of these oscillators. Extreme oversold on this ratio. The question will be whether or not we bounce back up above these moving averages like we did here and continue higher. Because over here, when we got to this extreme, the 8 was pretty close. We were able to bounce above it. We are way below the 8 right now. I mean, we are as much below the 8 now as as you typically see. In fact, let's just look at how far below the 17 we are. The red line. I mean, we are still pretty close to it down here at the worst of the worst. I mean, look how far below. We are more below the 17 now than I don't know when the last time we've been this far below the 17. On the ratio chart, right? You have to go back to over here to the election. Where we crashed below that and continued lower. We had a negative correlation then. However, we're much more positive correlation now. So again, and we weren't so, you can see when we did break down, we had a slight positive. Here we are a lot more. Like this is a very, very high level for the long-term PPO. So, again, it suggests a break in the market, a shift in sentiment, to where now the Qs aren't expected to outperform on this long-term basis. It looks like now IWM is going to outperform. Again, there's going to be days and weeks where Qs outperform, but for a trending basis, it looks like this ratio may begin to trend lower. In which case, again, considering its normal positive correlation, probably won't be the greatest thing for the equity market. It's not, as I've shown you before, it's not very typical for stocks to do well to have these other sectors outperforming. They usually outperform when there's weakness in the market, again, like we're seeing right now. The Qs you'll see here in just a second because of Microsoft and Nvidia in particular. We're down 4% today, XLK. And these other sectors underperforming the market, dragging it down to the 1.4. Everything else outpacing. But even industrials had a hard day today, dropping down 1%. Materials lagging behind. Energy did okay, but again, energy is a sector that is generally negatively correlated with the market. So here's energy and how it performed today, breaking up above its 30-day moving average in a very, very big way here. So you can see big time negatively correlated, 94% negatively correlated, breaking above 50 on the RSI, breaking above the 30-day average for the first time in a while. Let's just go back to our normal MACD here. The MACD is turning up and is looking pretty, bullish, coming off of that divergent low point we talked about. The PPO is pretty negative. The CCI is looking better. The DMI is looking better. So that's XLE. So now let's look at XLK relative to SPY, and you see that, okay, well, it's doing, like, it broke down hard in the last week, but especially today, breaking below the 200-day moving average. Remember how we talked about over here, not a good sign for the markets. For something that's 90% positively correlated with the S&P, it's not a good sign when this ratio breaks its 200-day moving average. And this MACD is as bearish as it is, and the long-term PPO is rolling over. Strong CCI to the downside, strong breaking into bearish territory on the RSI, and you see that on the relative rotation as well. Big moves in the last 5 days in XLI, XLF, XLB, XLE. Man, these are all sectors that are negatively correlated with the markets. Their ratio charts, excuse me, their ratio charts are negatively correlated. The 86% for financials, and it's breaking big time above its 200-day moving average. So big rotation up in these areas, big rotation down in XLK, XLC, and now in XLY. All right, now let's take a look at our trade idea of the day. Let's take a look at NVIDIA. So NVIDIA kind of broke down pretty good. Again, getting a bull tag, right? It was down 6.6%. It's down quite a bit over the last 5 days. If I take a look at the last 5 days, let's go daily price moves here. And let it come up, and let's pull up NVIDIA. And it's been, 1, 2, 3, 4, 5 days. So let's come over here and get it up to a 5-day decline. So we're down 12%. That's one of its bigger, there's only been one other 5-day decline in April that's been more. But more than that, if I were to take a look at its chart, it'd be in April, so it'd be over here. It'd be the end of that decline was about as big of a drop. So this is a bigger, a pretty decent drop. If I were to take a look a little bit further out in time, so let's look at a 5-year chart on this, and you can see there's a pretty decent sized gap too to the downside. But you can see there's 12%. You can see the bearish, like it doesn't drop like this during the bullish times. It drops like this during like the bearish times here. So, but the nice thing is, it's pretty, like, that's why I don't think necessarily. Give me 1 second here. So, so it is a down day. It is a down day from NVIDIA, but the nice thing is, like I said, those kind of big declines occurred under moving averages. That's the big decline that got us down to barely below the moving average. So with that bull tag, and like I said, bull tags are pivot points. We can either get a bull tag and start a new leg higher to the upside, or over there, like it did over here as well, or it can start new intermediate declines. So it's a really significant pivot point, one way or the other, for significant moves. Not just maybe it might move up a little bit here, or maybe it might go down a little bit more. No, it's a pivot point for significant moves in either direction, either an intermediate decline or a new significant leg higher to the upside. The intermediate line is out of bullish territory, but it's not in bearish territory. And the short-term sentiment is actually not that extreme to the downside there. It doesn't get too extreme like the S&P 500, so it doesn't have to. But it's not too bad. If you notice, the weekly chart for NVIDIA is also not too bad. It is a transition candle on the Hakinyashi, and that transition candle is pretty relatively bearish, but you notice no red arrow yet. So we haven't closed below that 10-week moving average yet. Things can change tomorrow or in the next 2 days because it is a weekly chart. But as of right now, it's not a bearish candle. You obviously have 3 red arrows on NVIDIA. 3 red arrows there. It's a very significant range, right? It was the average range without the gap, right? You add in the gap of, 126.36 to 121. So it's about another 5 points, almost another 5 points there. So you're at pretty much that 10-point range. So pretty extreme, and you're above average on the volume, but not too bad. So and you got 3 red arrows. So we have, but it's 3 red arrows with a yellow line. And you're still way up above the value area. Still pretty bullish here. You're still above the 50-day moving average. The MACD and stochastics haven't really broken down hard yet. So there's still an opportunity that we can bounce right off of that 50-day moving average and continue higher. The DMI looks kind of like the S&P 500, where you've had a little bit of a dip up above the 25 and a little bit of a dip below. So this, just kind of like this, we can reverse that pretty quickly and just turn right back up to the upside. Same thing with the RSI and the CCI. Sorry, that's right here. RSI and the CCI. Again, we're not below 40, and we dropped below 150, but not too extreme. We're still pretty bullish on a long-term basis. If you look at the Ichimoku cloud, we're still way up above the cloud. The rate of change is pretty flat, but we're still way up above the cloud, even if we have lost the trend. But that's okay. Again, we can continue the trend pretty easily when you are still. We haven't even turned. We're nowhere near turning pink, on the cloud here, which is plotted 26 days forward, right? So we're still okay. We're still very much okay. So like I said, there is an opportunity for a significant pivot on NVIDIA. Again, either to really start an intermediate decline to the downside. See, we did not get the lower band. We are in the lower quartile, but we're not below the lower band. The bands are actually still inside the Keltner channels, and we haven't broken out yet below that. So there's still a chance. So I want to take advantage of that chance with a very speculative trade. So I'm going to come down to the 20 delta and sell the 20 delta 136, which is around the old highs, buy the 134 for that. That's, again, it gives me about over a 4-to-1 reward to risk ratio, $2,100 to 468. My risk is very minimal. Very minimal. So if the stock does start an intermediate decline, I have very minimal risk. I might lose $100 or $200 or so. But if it does bounce back up to new highs, right, if we get a little pullback, because if you notice on the zigzag here, we have had a little bit of a pullback here. So zigzag, pull up NVIDIA, we've got a 12% decline, right? So for NVIDIA, which is a high beta company, that's a little bit of a pullback. So if we bounce back up and get back up towards 136, these old high points, then I can get a 4-to-1. And if it takes some time, I don't have a whole lot of flexibility for timing. It's a very speculative trade, trying to take advantage of a pivot point, right? Trying to take advantage of this signal, this bull tag signal. So we either bounce back up, great, kind of like this, and we bounce back up, or if it doesn't, the nice thing too is we're, from a portfolio standpoint, we're hedged on the NASDAQ in our class portfolio. So I'm actually covered for any significant moves to the downside, and I have an opportunity for a good trade to the upside if that bounce plays out. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.